Greetings, and thank you for joining us today. I'm Steve Kamen, a senior fellow here at the American Enterprise Institute, and it's my pleasure to welcome you to this afternoon's event on prospects for the European economy. I especially wish to welcome our panel of highly distinguished experts to this afternoon's session. I can't think of a better panel to shed light on the important issues we're going to be discussing today. So in the order in which they will speak, they are first Nathan Sheets, who's the global chief economist for Citibank. Before that, he was chief economist for PGIM Fixed Income, undersecretary of the US Treasury for International Affairs under President Obama, global head of international economics at Citi, and director of the International Finance Division of the Federal Reserve. In that last position, he advised Chairman Ben Bernanke and helped design the Fed's international response to the global financial crisis. Even more challenging than that, he was my supervisor as I attempted to evade his many scurrilous interventions. All right, following Nathan, we have Carlo Cottarelli, who's currently director of the Observatory of Italian Public Accounts at the Catholic University of Milan. In May 2018, he was designated Prime Minister of Italy, though a new government was formed before he had a chance to take office. Before that, he was executive director at the IMF board, representing Italy, Greece, and several other countries from 2014 to 2017. Carlo has also served, among many other posts, as Italian Commissioner for Public Spending Reform, head of the IMF Fiscal Affairs Department, researcher at the Bank of Italy, and visiting professor at Bocconi University. After him, Paolo Mauro is deputy director in the IMF's Fiscal Affairs Department. He was a senior fellow at the Peterson Institute for International Economics and visiting professor at the Johns Hopkins University Carey Business School. He's written on a wide range of topics, including corruption, the design and pricing of sovereign bonds, fiscal adjustment, and rethinking macroeconomics. And finally, last but absolutely not least, Desmond Lockman is a senior fellow and colleague of mine at the AEI, where he writes extensively on emerging market issues, monetary policy, and the financial system. Before that, he was managing director and chief emerging market economic strategist at Solomon Smith Barney. Desmond previously served as deputy director in the IMF's Policy Development and Review Department, where he contributed to the formulation of IMF policies. Now, by way of introduction, as you're all doubtless aware, the global economy is in a difficult place these days. Now, to be sure, the U.S. and in the U.S. and several other economies, it's a good time to be looking for a new job, and wages are rising briskly in many sectors and countries. But that's just about where the good news stops. Inflation is rising briskly around the world, and in response, central banks are tightening monetary policy or preparing to do so. This not only raises the prospects for an economic slowdown, but also boosts the odds of a crash in overvalued equity, credit, and housing markets. Rising energy prices are adding impetus to inflation, but they also represent a supply shock that further weighs on economic activity. Now, should a recession actually materialize, many governments will have already exhausted their fiscal space by propping up their economies during the early phases of the pandemic. And that pandemic, by the way, is hardly over. While populations in the US and Europe are partying like it's 1999 or maybe 2019, recurrent lockdowns in China continue to disrupt global supply chains. And finally, the geopolitical schisms triggered by Russia's invasion of Ukraine and deepening rifts between China and the West threaten a reversal of globalization that could restrain economic growth for years to come. Now, clouded as the prospects are for the United States and other parts of the global economy, they're even worse for Europe. First, Europe is more dependent on oil and natural gas from Russia and Ukraine, and is accordingly paying more for its energy needs than many economies. Second, the high public indebtedness of some European countries, especially Italy, poses more than merely a lack of fiscal space. A combination of higher interest rates, lower growth, and investor retreat from risk could reignite worries about fiscal sustainability in Europe's periphery and threaten a return to the crisis conditions of a decade ago. Now, this concern may be all the more pressing as the ECB pulls back from asset purchases that have restrained Italian sovereign spreads. And indeed, anticipation of this has pushed Italian bond spreads over German yields to their highest level since the start of the pandemic. Finally, while real GDP in the US and UK has largely returned to its pre-pandemic trend, output in the euro area has barely reached where it was in its previous peak in 2019. And in some countries, like Italy and Germany, GDP actually remains below that earlier peak. So fighting inflation and restoring public finances in an already weak economy will be all the more challenging for Europe's authorities. So in light of all this, I've asked our experts today to address a number of questions, among them, how serious is Europe's inflation problem, and what can the central banks do about it to ensure a soft landing? What are the right policy responses to the supply shocks triggered by Russia's invasion? And how sustainable is the public debt of the periphery? And what are the risks as the ECB's bond buying tails off? If you in the audience have questions that you'd like to ask of the panelists, you can send them to John Kearns via email or Twitter, as indicated at the bottom of your screen on the AEI webpage. And so without further ado, let me give the floor over to Nathan to start our discussion.
All right, well, very good, wonderful, wonderful to be with you and to have an opportunity to share some views on developments in Europe. And specifically, Steve asked me to talk a little bit about the city forecast and how we see the euro area evolving over the next year or two. To start things off, let me give you 3 key takeaways that I'll develop over the next 10 minutes or so. First of all, we see the euro area economy as being notably soft. And when we think about the risks, they're skewed to the downside. Secondly, and in contrast, inflation is high and appears to be threatening. And when you put those points together, it creates a nasty cocktail of challenges for the ECB. So Steve mentioned not a lot of good news out there. I think that that's right for the global economy and maybe particularly true for the euro area. Now let me drill down on this a little bit more. Following the intensification of economic and geopolitical stresses in late February, we marked down our growth forecast for the euro area from 3.5% to 2.4%. And we've kind of just stayed there ever since. That's where we've been for the last three or 4 months. Now, that number doesn't sound terrible on its face, but a lot of that is just kind of carry forward from arithmetic effects late last year and early this year. When you look at it on a quarter-to-quarter basis, we see growth maybe averaging 0.75 percentage point annualized in each of these quarters, a couple of tenths not annualized. It's very soft. If the 3 quarters end up averaging 0, then the annual average growth rate would be somewhere, depending exactly on the pattern, would be somewhere around 2.1. And quite frankly, I would say that's roughly where we see the bid-ask spread. Our modal forecast is 2.4, but somewhere in that range would strike us as plausible. Now, as I mentioned, relative to that, on balance, there's a lot more to worry about than there are encouraging factors. As Steve mentioned, high commodity prices are creating uncertainty, they're creating disruptions, they're interacting with supply chain tensions to create problems for manufacturing firms and production. I think the vulnerabilities in the gas space are particularly pronounced, and especially the possibility that one way or another, the gas flows may be shut down or limited at some point in the coming 6 to 12 months. And that's something that I think would be quite disruptive. More recently, due to the policy moves, oil is now under increased stress as well. And accompanying all this, there is a first order food price inflation that's working its way through. So these these commodity prices are very severe globally, but seem to be even more severe in the euro area. As a result, sharp drops in real wages, consumer confidence is falling off significantly. We've seen a meaningful increase in nominal bond yields, with Bunds now up to 160, and Italian government securities trading today at just a touch over 4%. That opens the door to a whole lot of risks surrounding financial fragmentation. I'll talk a little bit more about in a minute. I'm sure that my colleagues here will amplify. And then just for good measure, the Chinese economy is slowing as well. Over the last couple of months, we marked down our China forecast from 5.2% down now to 3.9%. Largely due to the disruptions associated with the lockdowns and the effects of the dynamic zero COVID policy. Now, lest I sound totally grim, I'd say on the positive side of the ledger, the labor market remains relatively tight, so that we are seeing ongoing employment. Tourism is rebounding some. And I think that's part of a global process where consumers around the world are feeling more comfortable spending on services, including tourism and travel, and that's been a support. And we can debate it, but from an economic standpoint, a growth standpoint, the weaker euro is probably also supportive. Now, moving to the inflation story, in some sense, it's the mirror image of what I just discussed. The euro area has been hit by a series of severe supply shocks. And what do those supply shocks do? They bring weaker growth. They also bring higher inflation. And we are certainly seeing that. It's commodities, it's basic materials that are driving it. And if I had to differentiate the inflation process in Europe from that in the United States, it's still somewhat more exogenously driven rather than endogenously driven as in the United States. And specifically, to date, we haven't seen the same moves in wages that we've seen in the US. Nominal wages, plus or minus, kind of in the neighborhood of 3% growth. In the US, it's 5%, again, plus or minus a little bit, depending on what you look at. Now, clearly, there are risks that as this headline inflation, which is now running at 8%, to the extent that it persists, that you'll then see those second round effects into wages, and the inflation process may become more endogenous and more self-sustaining. But I think that is a question where the jury is still very much out. Now, one other angle on this I should mention is our sense is that the pass-through of these commodities and these supply shocks into euro area headline inflation is likely to continue until the early fall. And we see headline CPI inflation topping out at 9.4%. Similarly, we think there may be a little bit more push in the core as well. Core is now a hair below 4%, and we see that topping out also during the early fall at around 4.5%. But obviously, a lot of this depends on the path of commodity prices and the extent of pass-through into wages. And we're watching the upcoming wage deals very, very closely to see the extent to which it gets incorporated. Now, as I said, weak growth, high inflation. It's a terrible environment for central banks, and particularly for the ECB. Now, I think the ECB really has no choice. Given the severity of the inflation problem, they've got to move vigorously to address it. But as they do that, I think that they understand that there are some significant economic and financial stability risks. As you tighten vigorously into a soft or maybe even slowing economy, there is appreciable recession risk. And I think the risks of recession in the euro area are a notch more pronounced than is the case for the United States. In addition, I mentioned earlier this financial fragmentation risk. And as we think about some of those peripheral countries, those countries are going to have to, as their economy slows and the ECB reduces its purchases as it's tapering, those countries are going to have to be issuing potentially more of their debt into what is likely to be a tough and maybe even deteriorating market environment. And exactly how that plays through and how challenging it might be is a first order challenge, I would say, for the markets, for the ECB, and for these countries. Now, the ECB has said they're going to develop a tool, that they'll do something. They haven't talked to us about what exactly that's going to look like. Of course, there'll be asset purchases of some stripe, but their features, their triggers, their sizes, I think remain open issues. And they are kind of pinned. If they're too specific about it, then there's a risk they face litigation. And that pushes them to a place where they have to be a little bit more vague. But then that leaves market participants uncertain. And when market participants are uncertain in these kinds of environments, they tend to test the limits to see where the boundaries are and what will trigger. So when you put all of this together, this is where I started. This is a challenging outlook. There's appreciable recession risk. There's similarly significant inflation risk. The ECB is going to do its best, but it's hard for a central bank in this environment to hit multiple objectives with one. Maybe you could argue they have 1.5 tools, but they don't have the flexibility to address this full sweep of shocks that we're seeing. And I'll stop there, Steve.
Nathan, thank you very much. That was a really comprehensive, super informative review of the outlook with a lot of focus on the key issues, in particular monetary policy. So I wanted to follow up on that because you kind of mentioned that despite the fact that most of the euro area inflation seemed to owe to supply shocks, and despite the damage that, its vulnerability to recession and the damage that could be done, you said something to the effect of, quote, the ECB has to tighten. And so I guess so first, when you say it has to tighten, are you thinking about it more from a political standpoint than from an actual economic standpoint? Which I have to say seems to echo some views about what the Fed faces as well. And then secondly, even if you kind of said, well, okay, so for lots of political reasons, as well as expectational reasons, the ECB is going to have to tighten. But let's say it tightens a couple of percentage points. Okay, so from -0.5 to 1.5. 1.5 is very unhigh or even low. And in principle, that might not even do damage to the European economy, right? So is that the way the ECB squares its circle here? That not bringing interest rates up to 3, 4, or 5, but doing a healthy increase in interest rates that doesn't really appreciably, affect the real returns to investment?
So my feeling is that the ECB has to hike for economic reasons. That and I'll continue to use kind of this nomenclature of exogenous inflation. The shocks are so severe, and it's driven headline inflation up sufficiently that if they don't react with some vigor, there is a reasonable chance that it gets embedded in the system. And then they've got a big problem trying to get rid of it. So I think it's the economics that I'm referring to when I said they're kind of in a corner and they've got to respond. at your point that, well, the politics is pushing them in that direction as well, that there are a lot of, let's be blunt here, Northern European governments that are not happy with headline inflation running 8, 9, 9.5% if our forecast is right in coming months. And that does, in some sense as well, give a compelling justification. But I was thinking more from an economic standpoint. Now, your question about how much can they hike, really, and how much of a bite is it going to take out of the economy is right on point. Our feeling is that, what the ECB can do maybe is go, the path we have in mind for this year is 25 in July, and then 250s and another 25. So our baseline forecast is the deposit rate is at 100 basis points by the end of this year. And from there, in our mind, now the markets have another 100, okay? But in our minds, at that point, it starts getting pretty murky between the financial fragmentation and the challenges there, what it's doing to the economy, and potential slowing, and of course, the possibility that there are additional shocks. So, we're not at all convinced that the ECB is going to be able to launch this thing, well above neutral, wherever that is for the euro area. And it may be that they can kind of thread the needle of showing they're committed and they're credible and they're defending their inflation target, but that that the tightening doesn't become the key story in driving the growth outlook.
All right. Well, 100 basis points doesn't sound like a lot to me, but why don't we, we can talk a lot about this. So why don't we hold off and hear what some of our other panelists have to say? So, why don't we now give the floor to Carlo, who will focus a little bit more on Italy's debt problems.
Yeah, thank you very much. I want to first comment a bit on short-term prospects for growth following on what Nathan just said. And then I will focus primarily on, yes, debt in Italy, but within the context of an increasingly difficult relationship between Northern European countries and Southern European countries. Now, on the short-term outlook, I'm a bit more optimistic on the fact that perhaps Italy, as well as other European countries, Euro area countries, can avoid a recession this year. First of all, most of the projections made by the IMF, the OECD, the European Commission, the growth, they all project essentially not a great growth this year, but not a recession. So essentially a flat economy. Italy did not start very well. We had a drop in industrial production, very sharp in January. But then there was a rebound in February, March it stabilized, and April has been a huge increase in industrial production. So after the start of the war, the momentum seems still to be there. As Nathan mentioned, tourism is doing very well, and in general, the service sector is doing better than expected. Now, this is the situation unless there are further shocks. It is a completely different ball game if we have additional shocks, either of a military nature or of a geopolitical nature or related to sanctions. If the European Union decided to stop the imports of natural gas from Russia, then there will certainly be a recession within for the next 12 months, because it's basically impossible to replace all the gas that Italy and other European countries are importing from Russia without going to rationing. So Italy can perhaps replace 2/3 of imports of natural gas from Russia from other sources, but 1/3, which is about 10 billion square meters of natural gas, cannot be replaced. This would lead to rationing, and this would lead certainly to a recession. But outside this scenario, I think we can survive. For the moment, as I said, the data do not seem to show much of there is not yet a sign of a clear recession. Now, having said this, sorry, one more thing. On the inflation side, instead, I think inflation is going to stay high precisely because the ECB, perhaps other central banks too, they are very afraid of causing a recession, and therefore they are moving very gradually on increasing interest rates. With the announcement made by the ECB, the reference interest rate for the ECB in September would be 0.5%. That's the annual rate. At the current inflation rates, a single month of inflation is essentially sweeping out the entire the yield at the 0.5 interest rate for the whole year. So in other words, real interest rates remain largely negative. But that's the situation now. Things may change. Now, in this context, I want to go back to the main topic of my intervention, namely this potential increasing conflict that may arise between Northern European states and Southern European states within the euro area, a conflict which may have pretty big economic implications and market implications. I have to start by going back a few years. The relationship between Northern European countries and Southern European countries was a very strained confrontation, I would even say, in 2012 and in 2011, 2012, essentially because of the different behavior of interest rates. Money was flowing out from Southern European countries, it was moving to Northern European countries. So interest rates were declining in Germany and they were rising in Italy. The problem was ended by Mario Draghi, with its famous whatever it takes, in July 2012, with the introduction of the so-called outright monetary transaction tool, the OMTs, a tool that would allow essentially unlimited intervention by the ECB for a country which had a program, a fiscal and structural program with the European Stability Mechanism, with the ESM. And then in addition to this, that was just an announcement that was enough to bring down spreads. This was followed by pretty large quantitative easing operation, which started in 2015 and ended in 2018. A renewed moment of tension between Italy, or in general Southern European countries, but particularly Italy and Northern European countries, came in March 2020 with the COVID shocks. Spreads started rising again, and this was overcome with the PEPP, this additional program of purchases of government securities by the ECB. That was one step. The second step was the suspension of the SGP rules. And the third step was the introduction of the announcement and then the introduction of the Next Generation European Union program, which potentially could provide 750 billion to countries of the European Union, and 200 of these are coming to Italy. Altogether, the relationship between Italy or Southern European countries and Northern European countries improved enormously over the last few years. Italy remains, it's important to keep in mind, remains one of the countries with the weakest support to the euro. And there is this new party called Italexit, which has now reached almost 5%, which was created just a few months ago. But of course, in 2020 and 2021, this sort of skepticism about Italy's participation in the euro area was muffled, was suspended at least by this huge inflows of money from European institutions. Italy received from the ECB and the European institution in 2020 and 2021 about 400 billion euros, 400 billion euros, of which most of it, 350, came from the European Central Bank. The fiscal deficit, the Italian fiscal deficit in 2020 as well as 2021 was more than entirely financed by the ECB by printing euros. So actually the debt of Italy, public debt of Italy towards the financial sector actually declined in nominal terms in 2020 and 2021. So, and that's just with the money from the ECB. And in addition to this, we got 50 billion in 2020, 25 billion in 2020, 25 billion in 2021 from the European Union. So in this situation, there was peace among euro area states and peace with the financial markets, with spreads that declined to about 100 basis points and interest rates for Italy that declined over a 10-year maturity to 0.5% in 2020. At the end of 2020, beginning of 2021. Repeat, 0.5% over 10-year maturity. Italy had never seen such a low interest rate, I think, since 1861. So since the birth of Italy as a unitarian state. Now, all this is changing, except the next generation European Union. Well, what is changing? The ECB has had to stop the purchases, or is stopping the purchases of government securities. Interest rates have started to increase. The European fiscal rules have been postponed. I mean, the SGP rules will sooner or later come back. They've been postponed for another year, most likely. They will be postponed. The Commission has proposed their suspension for another year, but they will come back in 2024. As to the next generation European Union, that remains, of course, so the money will come. But the easiest part of the next generation European Union will end at the end of this year. 2021, 2022, most of the actions necessary to receive the money from the European Union were of a legislative nature. You have to approve this law and so on and so forth. The actual implementation will come later on, including the implementation of these legislative changes. On the monetary side, interest rates are rising, spreads are rising. They are still low, as I underscored before, in nominal terms. And in addition to this, if we look at the public sector debt, we need to remember that this inflation is eroding the value of outstanding public debt in circulation, which is very good for the government. Keep one thing in mind, what is relevant in this field is not the CPI inflation rate, is the GDP deflator, which is much lower. Because inflation, as it has been noted by Nathan, particularly in the euro area, is important. But still, the GDP deflator is projected to rise this year by about 3.5% to 4%. CPI, we're talking about 7%, 8% at the moment in the euro area. But even an inflation rate for the GDP deflator of 3.5%, 4% is something that is really doing a lot in eroding the value of government security. In addition to this, 28% of Italian public debt is now held mostly by the ECB, through the Bank of Italy, by the way, and partly by the European Union. So from a rational point of view, the situation of Italian public debt is not as bad as it looks. This said, I'm really concerned about these dynamics that may start between Southern European countries and Northern European countries, again, involving, for example, issues like the introduction of an anti-spread mechanism by the ECB, which inevitably were to be something small and temporary. And all this may lead to increasing accusations over the next 12 months, increasing accusation by Italian populists against the Northern European countries and Brussels. We have already seen soon after the decision taken by the ECB, this very modest increase in interest rate, we have already seen the head of the Lega and the other right-wing party, the so-called Brothers of Italy, accusation that Brussels was not really Brussels, it was a fair in Frankfurt, but Brussels was strangling Italy, that there was a plot against Italy. And remember one thing, and with this I will conclude. Next year, in March or April, we are going to have general elections. And at the moment, the center-right, led by these, particularly by the Brothers of Italy party, which is more to the right than, for example, Berlusconi's party, they are going to win. And so this will create a political shock within the euro area, and this can lead to increases in spreads and interest rate for Italy, which are going to be more difficult to control than what we are seeing now. I'll stop here. Thank you.
Thank you, Carlo. That was a great, well, more than introduction, a great review of Italy's monetary and fiscal interactions with the European authorities, and about prospects going forward. If I could just ask you a quick kind of follow-up question, you have a view as to whether the anti-fragmentation measures, whatever they might be, that Madame Lagarde has talked about, do you think they will be necessary over the next year? Do you have a view as to what they might be? And do you have a sense of when eventually Italy could wean itself off of that QE?
Yeah. For the moment, the only thing that the ECB has announced in terms of anti-fragmentation measures is that if, say, a German bond comes to maturity, it may be replaced by an Italian bond in the portfolio of the ECB. That has not impressed financial markets. Has not impressed, and spreads have continued to increase. There are talks about possible anti-fragmentation measures of a temporary and limited measures. If that occurs, I don't see how that could help very much. So we know that the announcement of partial intervention measures have never been good as a tool to defeat speculative attacks. What would be needed is what was done in July 2012, unlimited, the ECB announces potentially unlimited intervention. Keep in mind one thing, at the time, these unlimited intervention were conditioned on a program with the ESM, which is now in Italy will be politically completely unacceptable. ECB, these right-wing party were even totally against the possibility that Italy would borrow from the ESM without essentially an adjustment, fiscal adjustment program, without any conditionality, except in the health sector in 2020. And I went through all these discussions in talk shows and in the media, and the word ESM is taboo now in Italy. So it would be very difficult to introduce something that would involve for Italy unlimited intervention without asking Italy to do something in exchange. So it doesn't look very good. Will it be necessary? I don't know. We'll see.
All right. Well, thank you. And thank you for reminding us of the futility of half-hearted measures. And since I think the parties that be are probably converging on half-hearted measures. All right, let's hear from Paolo, who's been patiently waiting to share his views on energy and food price shocks and what they mean for the euro area.
Thank you, Steve. It's really a great opportunity and a pleasure to be here. And I'm going to do something which is a little bit different. I'm going to start from the specific to then go back to the general issues that are being discussed. So I want to begin by looking at what I believe is the issue that is on the mind of EU citizens. And here I want to emphasize, really, there's no distinction between Southern Europe and Northern Europe. When people go to the supermarket, they all are worried about inflation. And I think in particular, people are worried about increases in food prices and in energy prices. I'm putting up some charts here. You may be familiar with them, but I think it's important to remind ourselves that the current commodity price shock is not completely unprecedented. In fact, we've lived through 3 such shocks in the past 1.5 decades. And there are some interesting and important differences to keep in mind. So first of all, the oil price shock is of a magnitude that we have experienced before. What is a little bit less common is the shock to food prices. The shock to food prices has been more pronounced than in the past 2 episodes that I'm showing on the chart. And I want to show a little bit more in detail what happened in the aftermath of the invasion by Russia of Ukraine. And what you see on the chart is that all of the prices spiked at the beginning of the invasion. But since that time, the price of oil has actually come down a little bit. Maybe it's stabilizing. We don't know. Perhaps the war will continue and high oil prices will persist or rise even further. But at the moment, we are at about the original peak or a little bit below. That's not the case for natural gas, which of course, as some of the previous speakers have highlighted, is even more important for Europe. So natural gas prices are still going up. But what is remarkable is the very sharp increase in food prices and wheat in particular. And that is something that has definitely become a lot worse since the invasion. In fact, wheat prices in particular have almost doubled and have stayed at that level since. So what would one recommend? Obviously, for the typical European country, when commodity prices go up, there's a loss. And the job of governments is to decide whether you want to do something about the distribution of that loss. It's a policy choice. What we typically recommend as economists is to allow price signals to operate. So typically we recommend that increases in international prices pass through to domestic prices. And while that's allowed to happen, it's important to provide support to the vulnerable groups of the population. In countries with strong social safety nets, which I guess is the majority of the European economies, there are ways of doing so. In addition, if one is particularly concerned about, for example, the political sustainability, the role of the middle class in sort of maintaining a certain degree of social cohesion, in addition to the usual social safety nets, one may consider providing lump sum discounts on utility bills. So, for example, you could give a lifeline for electricity, you could give a certain amount to all households for cooking gas consumption at relatively discounted prices.
Excuse me, Paolo, did you mean to be advancing your slideshow? Because I think we're still looking at the first slide.
Oh, it's moving for me. I guess it's not moving for you guys, and I apologize for that. But I can I can unshare and talk, and I think that's completely fine.
Well, you could try unsharing and then resharing and see if that works. And then if not, we will just rely on your excellent speech.
Why don't we give it one more shot?
Yeah, exactly.
It worked when we tried it before, and I don't know why.
Because you have some very good slides, so it'll be nice if the audience can see them, but not essential. All right, now I'm seeing.
So, and you see that I moved my slides.
Yes, so whatever,
okay, good.
Whatever you're doing.
I don't know what froze. Okay, so basically we have policy advice that we as economists would usually agree upon. We have to be very nuanced and realistic in terms of ensuring social cohesion, and that will depend on particular country circumstances. I think we have to be mindful that, as Carlo was mentioning, the political situation is fragile, not only in Europe, but elsewhere as well. And then comes the question of what are countries actually doing? Are they kind of following your typical economist's advice? And what we see here is that on the whole, advanced economies which have better access to financing are being more forceful in trying to support their citizens. And in many cases, they provide cash support, which is something that we have just agreed would be sensible. But in addition to that, really the bulk of the measures undertaken is in the form of either price caps or subsidies or cuts in taxes of various kinds. And what this is doing, unfortunately, is it is preventing the incentive for people to save energy. And it's implicitly, at the global level, it's implicitly still pushing up the prices of fossil fuels. It's still sustaining the consumption of those sources of energy. And that's particularly worrying when it comes to low-income countries that are not able to support their populations, but are inheriting these high prices of commodities in general. I'm summarizing that here with the pass-through of international prices to fuel in particular, which is easier to measure. And you will see that in calendar year 2021, for advanced economies, that pass-through was essentially complete. But in 2022, when the shock became more severe and was on top of some other shocks, you see that the pass-through has become more limited. And so there's a sense in which there's a little bit of fatigue, if you will, and more concern about the effect of high commodity prices, and governments are leaning against the wind in the way which I mentioned, which from a macro standpoint has some adverse consequences.
Hello, if I could bother you, your screen's frozen again, but you're doing a great job of describing what's on the screen. So perhaps the best thing would just be to unshare and speak, knowing that, knowing that you're doing a good job of describing it.
Thank you for that feedback. I will, I will just make a couple more points and then I will stop and we can chat. Of course, the first best thing to do in this kind of situation is to promote the use of renewables. There is a good chance for Europe to do so through the Next Generation EU financing that Carlo mentioned. Unfortunately, that takes some time, but it is important that policymakers move very expeditiously to undertake these investments in renewables as fast as feasible. Now, let me step back and return to the macro fiscal side. So we started out in March 2020 in a situation in which monetary policies and fiscal policies were working very well together. We were in a situation in which not only the very lax monetary policies of the main central banks, but also the very courageous and massive fiscal interventions to support people and firms really saved the global economy from deflation and the recession, or at least cushioned the amount of that recession. Now, in advanced economies in particular, we had a massive increase in deficits, which was appropriate at that time. And now gradually in 2021, 2022, those deficits are set to come down. That has already happened in emerging markets and even more so in low-income countries where, of course, the degree of support had to be smaller because of lack of access to financing. What I want to emphasize is that the context in which fiscal support is being provided has changed completely from the beginning of the pandemic to the current situation, essentially because of the rise in inflation and perhaps even more importantly, because we're no longer at the effective lower bound. When you're at the effective lower bound, fiscal policies actually help monetary policies achieve their objectives. But right now, we are in a situation that is completely different. We have monetary policy that needs to be the first policy to act against inflation, but also fiscal policy has to do its part in at least not adding fuel to the fire. And so a more restrained fiscal policy at this point is warranted. I'm just going to end by reading out to you the public debt projections for the euro area. And in 2019, the average public debt ratio for the euro area was 84%. It jumped to 98% in 2020. And what I want to emphasize is that even within the last few months, we have revised the path for those projections significantly as a result of the pace of inflation. So in October of 2021, we were projecting a gradual decline of the debt ratio from 98 to 95 in 2024, so a sort of steady and slow decline. And in April, so just within a few months, we were projecting that that decline would go all the way to 92% of GDP by 2024. So the erosion that is coming from inflation is somewhat significant. We certainly would not advocate deliberately using inflation as a way of reducing public debts. In fact, that is actually a way of making it harder for the markets in the long run. But there's a little bit of reprieve, if you will, on the numbers, as Carlo was mentioning just a moment ago. So again, to conclude, very important support in the early stages of the pandemic from the fiscal side, very appropriate now to withdraw that support while being mindful that there are still people who need to be supported vis-a-vis the important shock that is coming to through energy and food prices. I'm going to stop here. Thanks.
Thank you, Paolo. That was an extremely topical review of these energy and food price shocks that have been in the headlines every day. I wanted to follow up on your discussion toward the end of kind of like public debt trends, and note that at least in the April WIO, which I am Fiscal Monitor, you have Italian debt to GDP falling from 151% last year to 143% by the year 2027. And actually, we've gotten a question from Mark Sobel, who I'm pleased to see is in the audience, and you probably know him from back when he was harassing you from the USCD's office. asking basically about, your view on what the drivers of that are, and even if the outlook for Italian debt looks good over the next few years, what about the issues of long-run sustainability and growth?
So, well, many questions, and I think I can just about begin the conversation there. So the first point I will make is perhaps a trivial accounting point, and that is that it's all about growth. It's all about real growth. When your debt ratio is very large, then the impact of economic growth is much greater than it would be if your debt was 20% of GDP. So all of the recommendations to improve the pace of economic growth in the long run, I think that's really the highest priority in my mind. And as Carlo would teach me when we were together at the fund, it's not just that the pace of economic growth affects the denominator of the debt ratio, it also has a huge impact on the primary deficit through the revenue collection. So priority number one is to secure a steady pace of economic growth. Of course, one of my hats is to worry about fiscal risks around the world, and there are many fiscal risks out there. One that is often not looked at in a lot of detail is the fact that many European economies have issued guarantees, and appropriately so, in the early stages of the pandemic, but some of them are still out there, and so we shouldn't forget them. That said, I think under reasonable assumptions, we have this declining path of the debt ratio. And of course, we all recognize that there's a large band of uncertainty around it. So I'll stop there and happy to follow up.
Thank you. Well, we may well do that. But first, we need to hear from Desmond to hear what he has to say about the European economic and financial situation.
Thank you very much, Steve. Thanks for organizing this. There's a lot that I agree with of what has already been said. What I propose to do is look at the European outlook from the ECB's point of view. But before I do that, let me make just a couple of points. The first that I'd make is that the ECB is in a very similar box to the box that the US Federal Reserve is in. Namely, that in the same way as high inflation is forcing the Fed to raise high interest rates, the challenge for the Fed is how does that do that without bursting the credit, equity, housing market bubbles that they made through very easy money policy. For the ECB, the challenge is how do they deal with inflation without causing the euro to come apart in that we get another round of the euro sovereign debt crisis. That's something that Carlos touched on. How do they finance Italy's needs, if we go into recession? The second point, before getting into my PowerPoint that I'd like to make is, how does monetary policy work? How does it slow the economy? And here I'd say that I wouldn't focus on what the level of interest rate is as much as I'd focus on what are the rising interest rates doing to the asset and credit bubbles that we've got. So what we're seeing is that as the ECB and the US Fed tightens monetary policy by raising interest rates, the bubbles burst because those bubbles were premised on the continuation of very low interest rates for a long period of time. Once you get those bubbles bursting, that has a very big deflationary impact on the economy. If the economies go into deep recessions, I don't believe that inflation is going to be our big worry. Our big worry is going to be how do we get these economies to revive again. So that's just by way of introduction. Let me go to the slide presentation. So basically, the way I see it is that the ECB's really got three challenges right now. Its main challenge, that's its mandate to get inflation down to 2%. If we go to the next slide, what we're seeing is what's mentioned is inflation in Europe is the same at the headline rate, and that's the ECB's what it's supposed to be doing is bringing that down to the 2% target. But even if you look at core inflation, you strip out the energy and food prices, we're at 4%. So that's the first challenge. The second challenge that the ECB's got is what do they do about the euro? That the euro's lost something like 15% of its value as the United States has moved to tighter monetary policy. They've been lagging behind. The euro's taken it on the nose, lost 15%, and that complicates their inflation problem. The third challenge, if we go to the next slide, is what do we do with Italy? How did we finance Italy? How do we prevent the interest rates in Italy not getting out of hand that makes their debt totally unsustainable? And here we've already seen very discouraging news, that the spread on the Italy versus Germany has now gone up to 240 basis points, meaning Italy now has to borrow at 4%. So what might have been viable, with a very high debt level at 0%, it doesn't look too good at 4%. If we go to the next slide, please. So just to go over how the ECB responded to the recession that was caused by COVID, looking at the next slide, firstly, what they did is they kept interest rates at negative levels. This looks really way out of whack when you've got inflation running at 8% to have interest rates at -0.5%. But the more important thing that the ECB did, which would be in the next slide, is what they did to their balance sheet. So the blue line is the ECB's balance sheet. We see that it expands very similar to what the Fed's done. They've bought bonds to the tune of something like $4.5 trillion, that the size of the balance sheet is now $9.5 trillion, same size as the ECB. And if we go to the next slide, we see what it's done. Just look at the left-hand side. The first two columns are what it was doing in 20 and 2021. Is the red dot is what the net issuance of the governments was, and both the blue column and the shaded column above it, that is what the ECB's bond buying is. So what the ECB was doing is they were buying more than the net issuance of countries in Europe. So it's a little wonder that Italy's, despite its really very poor fundamentals, it was able to borrow, as Carlos says, at close to 0% because the ECB was buying all of the issuance. If we go to the next slide, I should also mention, this is a point that Carlo is talking about, is that north-south hostility, is that what we've got is not only is the ECB did it buy a huge amount of the peripheries bonds, but we've also got Target 2, the famous Target 2, in terms of which Germany has a claim on the ECB now of something like $1.1 trillion. And it's got the claim against basically Italy and Spain, which have got negative balances in that account of something like $500 billion. So here's a source of great friction. My expectation is that as Italy runs into problems, we're going to see that account, get to bigger levels, and that's going to be very sensitive. The Germans, I'm not sure that they thought that they were signing up for this, to have bailout through the back door. If we go to the next slide, what's now occurred is that the party is over, basically, is that the ECB has been forced to shift policy. What's doing, as Carlo mentioned, they've stopped buying bonds under the pandemic emergency purchase program. That was something like $1.85 trillion, which basically went to the weaker economies. They're going to stop buying bonds in the fall. And now they're going to be starting to raise interest rates. And all of this will cause huge problems for financing Italy. If we go to the next slide, we see that Italy, if move one slide further, Italy's public debt is now around about 155% of GDP. If you look at the left part of this chart, what it shows is that before the pandemic, we were at 135. So we're now at a very much higher level than we were in 2012, that we something like 15, 20 percentage points of GDP higher. I'm not sure I see how Italy can finance itself without the ECB coming back in to buy up all of the bonds. Let's go to the next slide. This slide just suggests that there's no way that Italy, given its track record of growth, stuck in a euro straitjacket, there's no way that they're going to grow their way out of this problem. If they're forced to engage in fiscal restraint in a euro straitjacket, I don't see where the growth comes from. If we go to the next slide, it's basically suggesting that within the euro, Italy loses a lot of competitiveness over the past years. So that's not a good condition for growth. One more slide. This indicates the pressure on Italy in terms of financing. Foreigners are already pulling out of Italy. My view is that one shouldn't be looking at Europe just in isolation. We should be looking at it in terms of what's going on globally. And globally, as markets are melting down, you're going to have risk off. People aren't going to be wanting to take a risky proposition without knowing that the ECB is fully behind it to keep that propped up. One more slide. And this slide is just showing that interest rates, as Carla mentioned, got down to something like 0.5% in September 2021, and now we're at 4%. So I think that Mrs. Lagarde has really got a great problem on her side. How is she going to hold this together? On the one hand, she tells us that she's going to do whatever it takes to save to keep the euro together, to make sure that Italy is properly financed. On the other side, on the negative side, she's totally unspecific, to talk about, just going to be rolling over or, shifting around some of the portfolio as it comes due. There's no way that that's going to finance Italy's borrowing needs, Italy's gross borrowing needs. Carla can correct me if I'm wrong. The IMF is showing it as something like 34% of GDP, somewhere around about 700 billion euros. This is really going to be a very big challenge. So when you overlay it with what Carlo's saying on the political side, we're really heading for a showdown in Europe, whether the Europeans can come up again with whatever it takes, pump all the money in to keep Italy afloat. That we're going to soon see. Just to end this with addressing one of Steve's point of view, when we see spreads go up at the rate in which they're going up in Italy right now, there's no question that they're challenging Mrs. Lagarde, to ask her, show us the money, show us that the Germans are prepared to go along with financing Italy, without conditions, which is what essentially is going to have to happen if we can hold this thing together. So I'll stop there.
Thank you, Desmond. That was did a great job of highlighting the tremendous tensions that face policy in the euro area, and seemed like you enjoyed it too. So I wanted to, so if I heard you correctly, you said toward the beginning of your discussion that inflation was actually a less dire threat to the euro area than the financial crash that would come from like excessively aggressive tightening of monetary policy. So if you actually were in Madame Lagarde's chair or shoes or whatever, and you had to make the calls, would you, what would you do? Would you in fact desist from tightening too aggressively because of the worry of precipitating a crash, or what?
Yeah, well, I think that inflation is going to be a lesser problem, not only for Europe, but I think globally, because basically we should distinguish between a price level change and an inflation process. For inflation to be maintained at this 8-9%, we need oil prices now, instead of just going from 80 to 120, they need to go to 160 to 200 and so on. And if you're going to have a global contraction, if we've got problems all over the globe, not just in Europe, we're going to have a demand side issue on the inflation. So I don't see inflation as being, it's really, how do you avoid a really hard landing? But they're trapped, because they've got to deal with the inflation. If they don't raise interest rates, they risk losing control of inflation. Then it just means you get a harder landing down the road. With Mrs. Lagarde, she's got no option. She's got to come up with something to figure out, how do you finance Italy in a big way to keep the bond buyers happy. You've got to come up with a very credible way. She's got to do what Draghi did in 2012 or so, say that she's going to do whatever it takes, but then actually Draghi came up with an outright purchase mechanism that was very credible, and he didn't have to spend a dime out of that, and he managed to calm markets. That her challenge, it's going to be more difficult for her because it's not just Europe that's in trouble, it's the whole of the globe that's in trouble. Risk is off. You're really going to have to come up with something very credible to hold that together, but she's got no option, because the alternative is the Europe comes apart.
Desmond, do you do you think that so is the monetary policy prescription a little different in the euro area than in the United States? In other words, do you think that in Europe, both because their inflation is more supply side driven and because they have greater risks of financial instability, that for Europe, the prescription is somewhat less aggressive monetary policy tightening than in the United States?
I think that it's awkward, that it's very difficult for the ECB to be out of step with the United States, because what we're seeing is the fact that they've been out of step, the euro has fallen out of bed, so they've got no alternative. If the US is tightening interest rates, they've got to move in a similar kind of direction, irrespective of what their condition is. Otherwise, they're really going to have problems on the euro.
All right. Well, I would, I'll put my question out for our other expert panelists, and I'd love to hear what they would, say about this critical issue. And if they don't volunteer, I'm going to call on them, just like in class. All right, Nathan, what do you have to say?
I think that for now, the ECB has to show determination to fight inflation. I think the risks of them not moving isn't that somehow we're going to continue to see 8 or 9% inflation in Europe. And I agree with Desmond that energy prices aren't going to keep going up forever. But I think the risk is that if you have high inflation, it becomes embedded in inflation expectations and wage demands. and you kind of kick in a number of mechanisms through wage negotiations and other mechanisms that could generate stickiness in inflation and inflation expectations, and you have a longer-lived inflation problem. Now, where I think it's different than the United States as they both launch is that I think that the headwinds in the economy, and hence the headwinds on tightening, are greater. For example, there's a much lower, in my view, a much lower neutral rate in Europe than is the case in the United States. And I think that there's also likely to be, through this financial fragmentation channel, more kinds of financial tensions and challenges that arise than in the US. So I think that they both need to launch, but I think, pound for pound, that the Fed's going to have to go probably twice as far as the ECB does. And that's in a favorable scenario. In unfavorable scenarios where the recession risks kick in, then they get deterred even sooner.
I think, can I go?
Yes, please.
I think that increasingly the difference between the US situation and the euro situation is becoming less important, in the sense that we now have signs that inflation, the base for inflation is broadening in the euro area too. The latest number for the core inflation rate in the euro area in May was a monthly increase of 0.7%, so 8% on more than 8% on an annual base, on an annualized base. It's true that the signs of wage increases are more limited, but you need to take into account that at least in some part of the euro area, what we observe as wage increases are mostly the unionized wage increases. But there is a large part of the economy that is not unionized. The number of self-employed is much larger, for example, in Italy than in the United States. The number of people involved in the gray economy are also much larger. So perhaps we already have signs, maybe it's already happening, although we don't measure the wage increase. Now, however, having said this, if the question is, will the ECB move more aggressively and as aggressively? First of all, even the Fed is not moving particularly aggressively regarding interest rates and regarding monetary policy. But in any case, the ECB has one problem that the US does not have to deal with, which is causing a breakup of the euro area if spreads become too large. And the issue that Desmond was mentioning before, that we want to have a euro area that is based on permanent transfer from Northern Europe to Southern Europe. And this will lead the ECB to a much more cautious approach in raising interest rates, because of the implication on what we call fragmentation of the monetary policy transmission mechanism, which means the spreads.
Right. Paolo, I think you wanted to add your thoughts.
Sure, yeah, just a couple. So I'm curious whether we can bring inflation down without a significant rise in real interest rates. And of course, the longer we wait, the more real interest rates become enormously negative. My suspicion is that if one is comparing today's economies to those of the early 1980s, there are some important differences. One is much less prevailing indexation, and the other is much weaker trade unions. So in some ways, maybe to be optimistic, the wage price spiral story is going to be very different than it was in the late 70s and early 80s. I would think that the approach that has to be taken is one in which you raise interest rates a little bit and you see what is the financial market response. Because it may be that in the United States, we have a further decline in asset prices, and that we know tends to reduce demand. We know there's a strong correlation with growth next year. The equivalent in Europe may be that if you increase interest rates, you start having these spreads that go up. But essentially, it's the same kind of balancing act where really the channel through which demand is compressed in response to increases in the policy rate is through a financial channel. And the financial channel may be different in the two big blocks, but there are some similarities there. So that's all I've got for the moment. Thanks.
Paolo, while you're holding the floor, I've gotten a couple of questions from the audience that are interested in energy and natural gas prices. What if they soar this winter? What if supplies are disrupted? What can the authorities do about it to prevent a recession? And what might the political implications be? Any views on that?
Very tough.
Okay.
You know, it depends on I think it becomes almost an engineering issue, if you will. And I think there are all of these studies out there that say, you know, how much can you survive without natural gas, and what you do, do you go to rationing and so on and so forth. I think that, yeah, it's a tough balancing act. And in some ways, it's important to pay a lot of attention to maintaining social cohesion in that scenario. So that would be my 5 cents worth.
All right. Well, we'll tell our audience on that one, we can't help you, but we do like to talk about monetary policy. So to get back to that, there's a lot of the focus actually is on second round effects. In other words, if there aren't going to be second round effects into inflation expectations and core inflation, then monetary policy tightening is less needed than if there are these second round effects. So does anyone have a view? Well, first of all, let me note that the euro area went through almost a decade of below target inflation. So it doesn't seem like it's an inherently inflationary economy. But that said, what is the actual evidence on whether inflation expectations and pass through into core is rising in the euro area? Does anyone have a view on that?
Okay, I just mention again, in May, the core inflation in May for the euro area was 0.7 in a month. I don't remember the figure for April, but it also in April was pretty high. So it's going up. I think one chart was shown by Desmond on the 12-month inflation rate for the core inflation rate for the euro area. But again, if you look at the monthly inflation rates for core inflation in the euro area, we are already, and you annualize them, we are already running at a speed of about 7-8%. So it's happening.
All right. Any other views on that?
I would say, Steve, that your point is well taken. That said, I could have made exactly the same arguments for the United States, and probably, in all honesty, did make similar arguments 15 months or so ago. And I think what we saw is that if the shock is large enough, it can start to have an impact on some of these relationships that had been stable for even a generation. That there's some level of pressure in which these things start to give. Now, in the U.S., we're still not seeing really a move in longer-term inflation expectations, and notwithstanding everything, that has continued to be well anchored. And so I think the analogy is to the euro area, that indeed you're right. I think that we have been surprised so far regarding the discipline in wage negotiations and wage settlements. When the agreement was reached regarding the German minimum wage, we said, aha, that's really going to kick off a new round of wage increases. That doesn't seem to have followed there's more to come this year, and we've got to watch and wait. And I think it's a risk, but it's something we haven't seen yet, and it's something we haven't seen in Europe for quite some time.
Well, that's what makes this so tough for central bankers these days. We only have about 5 minutes left in our webinar, and I'd like to give each of our panelists the opportunity to leave us with about a minute's worth of last words for this webinar. And we'll do it in reverse order, starting with Desmond. So if you'd like to, provide a takeaway message for our audience.
But I would say that the central banks have made a big mess through far too easy monetary policy, not in 2020, but in 2021, at a time that you were getting fiscal expansion, for the central banks to have monetary policy the way that they did, that has put them in a position today where they have really no good choices. So their choice is either, take the pain now, deal with the inflation and get the recession right now, or muddle through, keep monetary policy too easy, have inflation take hold, and then you're going to have to slam the brakes on later. So I don't buy, the notion that there's an easy way out. We've seen central banks paying the price for policy mistakes made in the past, both in the United States and in Europe.
All right, very good. Paolo?
So let's see if I can be a little bit more optimistic. So I would say that I think one of the questions that you asked us for this panel was to reflect on whether there are some reforms that Europe could undertake to kind of move forward and face these challenges. I don't propose to have a solution, but it would seem to me that implementing all of the good things that have come, for example, from Next Generation EU, doing that very quickly would be the bare minimum start. Going beyond that, moves to maybe add a central fiscal capacity for Europe would certainly do quite a bit of good. And more generally, reforming the system of fiscal rules, fiscal frameworks. All of these are reforms that can help. Maybe they don't fix everything, but they would certainly go in the right direction. I'll stop there. Thanks.
Well, we know that Europe only does its institutional reforms under the pressure of crisis. So maybe this will be the opportunity for the next wave. Carlo, would you like to opine on that?
The final word is about, I'm concerned about inflation that is not coming down anytime soon. And I agree with Desmond that something went wrong in 2021 with fiscal policy and with monetary policy, which were, as Larry Summers argued at the beginning of 2001, there was just too much of a good thing. They went. By the way, the excuse of some central banks is that it's not our fault if raw material prices, if commodity prices went up. These are international prices. We don't control them. The question is who is responsible for increases in energy, in commodity prices? The world is a closed economy. The world is a closed economy. And central banks need to talk to each other, keeping in mind that if they run a too expansionary monetary policy, the first thing that will happen is an increase in commodity prices, which are determined in markets where demand and supply cross every day, and prices go up if there is too much demand. There is no such a kind of cooperation. Therefore, each central bank says it's not our fault if commodity prices go up. Well, it's a collective fault.
All right. Well, central bankers should keep that in mind.
Yes.
Why don't we end this with an ex-central banker? Nathan, you get last word on this.
Let me join Paulo in trying to be upbeat. It really seems to me that the heart of the challenge here is a series of severe supply shocks, that it's working its way through the global economy and through the euro area. economy. And my list there would be the supply side effects of the pandemic, supply chain disruptions, and then commodity shocks and other effects from the geopolitical disruptions that we faced. And we've got to presume that those shocks are going to be around for a while. But one can tell a story that I think has some plausibility that over the next 6 to 12 months, at least some of those may look somewhat better. And as they reverse, and to the extent that they reverse, I think that then some of these challenges that we face and that we've discussed for the last 90 minutes are likely to look less threatening. So I think that is, through all of this, that's kind of the ray of hope. And I think that's where the Fed was and other central banks were in 2021. They're expecting it to come sooner. And now, we can't expect it to come sooner, but maybe it comes later. And we ought to bear that in mind.
Let's hope.
All right. Well,
exactly. Here's hoping.
yes, exactly. And I have heard it said that hope is not a policy.
It's not.
But maybe it's the next best thing. On that, I would like to thank our audience for tuning in, listening to our conversation, and providing some excellent questions. And especially, I'd like to thank our expert panelists for spending their time with us to prepare such excellent presentations and giving us the benefit of their views. So with that, I'll conclude the presentation, and I look forward to seeing you at a subsequent AEI webinar. Thank you.